Hello, and welcome back to Accounting 2301. This is your host, Professor Naragon, bringing you Chapter 11, and all dealing with corporations, mainly dealing with stocks. But in order to know about stocks, we have to deal with what is a corporation. Corporations are the only ones that really issue out stock. They are known as a separate legal entity, and basically that means they are distant from anybody who created. They're like basically a kid. They're their own person in many ways. They have their own legal identity, so they can live forever most of the time. Now, because of this, they don't have a one owner. They have many owners. In fact, they sell it in shares of ownership called the stock. So whenever you hear the stock exchange, this is basically all corporations that are dealing with it. Now, the characteristics give corporations basically the ability to raise large amounts of capital in a short period of time. We can sell a lot of stock, and we can get more money very quickly. So this is a little bit different between bonds that we deal with in Chapter 10. So we're going to get into stocks. So a little other terms to know when we deal with corporations. Ownership is basically known as shareholders. They're the people that have the stock. Okay, they're going to buy and sell freely. So every time you buy and sell stock, you're a shareholder of that corporation at that time. So here comes something that we've already dealt with, one of our categories. And that category in itself is dividends. Okay, so we're going to get into more of dividends as we progress in this chapter. And again, this is basically transfer of earnings to the stockholder. The next little part that we have is basically the structure of itself. So, stockholders, we get the kind of little power, you want to say, we get to elect the board of directors. And the board of directors, we want to make sure we get a good variety, you would say. And sometimes people can elect people from other corporations in the same category to be the board of directors. It happens. I mean, anybody can be a board of directors as long as it's picked by the stockholders. From the board of directors, they get to pick all the executive officers. So the CEO, the CFO, the vice president, the president, all those come from the board of directors. And then from the officers themselves, they get to pick the employees. They get to hire on the managers, and the managers hire on the employees, so forth and so on. So at the top of the food chain is, of course, the stockholders. And if we don't make the stockholders happy, well, they're going to demand change. And they can cause change very easily. Now, corporations, they have really one strong negative. Most people don't really see it very much because they don't know about it. But the negative here is double taxation. A corporation is subject to income tax. They pay their own income tax. Again, this is a separate individual, basically. But when they issue out the dividend to any shareholders, well, guess what? You have to pay tax on that. You have to declare it on your tax return that I received this dividend. So again, you're even going to have double taxation of what's going on. So, I mean, dividends are the only item that ever gets taxed twice when it comes from a corporation, because it comes from the income tax that's already been taxed. Okay? But there's a huge positive. One positive for corporation is known as limited liability. Okay? So that means basically creditors can only go to the assets of the corporation. They cannot go beyond that. So they can't go after your personal stuff. Okay? The only thing you're going to suffer is the amount that you invested. Okay? So your stock is going to tank, yeah, but they're not going to try and repo your house to cover the losses of the corporation or anything like that. This is totally different between a sole proprietorship. When those, you can lose your personal stuff. They can take the clothes off your back if you're in one of those soles. So limited liability actually helps you out, and you only lose what you put in. Okay? So again, here's a nice chart of all the advantages and disadvantages. I would probably encourage you to pause the video, read a little bit, see what they are, because there's a lot that goes on with this. Okay? So what we want to get into, and basically the bulk of this chapter, is going to be about stockholders' equity. Okay? So stockholders' equity in itself is made of about two resources. One is paid-in capital, and the other is retained earnings. Okay? So we already know retained earnings. This is basically earnings that get reinvested into the company. They basically show how much net income that the corporation has minus whatever dividends. So retained earnings, we're not going to go heavily deeply in. What we're going to focus on is paid-in capital. Okay, this is what stockholders have invested into. So we're going to get a little more into that. Fun stuff. Alright, so when we're looking at paid-in capital, there is sources of it. The main source of paid-in capital is, of course, stock, because we're dealing with shareholders. Now, stock has a little bit of different terminology. First off, shares are authorized. These are in the corporate charter when they issue it to the SEC, to investors, so forth and so on. And of course, they get the little ratings and whatnot. But authorized stock is stock that's available to be known as issued stock. These are stocks that can be issued out to shareholders, okay, or that has been issued out. Now, the basically issued means stock available right now. At some point, corporations may reacquire these stock, and we're going to have what is known as Treasury Stock, which of course we'll get into in a few minutes. But any share that remains in the hands of the shareholders, that's not authorized or authorized to be issued, basically, is called outstanding shares or outstanding stock. Okay? So, when we're talking about what the shareholders have, we're mostly just dealing with outstanding. Okay? So we're always going to have lots of authorized in case we need to make more money. We're going to tell that there's a certain amount that's actually issued, and the outstanding again is what's currently actually in the hands of the stockholders. Okay, they're outside of the company, so they're outstanding. Alright, sometimes we have to figure out outstanding shares if we have to. Basically, it's issued shares minus treasury shares. Okay? So, we can actually figure out this if we actually have treasury shares. If we don't, then basically then it's all issued shares. It's not usually going to be the case. Dividends. This is a big note. So, dividends are only paid to outstanding shares. Again, dividends are basically earnings paid out to shareholders. Well, shareholders only have the outstanding shares. That's in their hands. So dividends are only paid to outstanding shares. So here we go. We're going to get into a little bit of finance real quick right now. And the big quick thing is par value. What is par value? Par value is the monetary value, or basically the face value of the stock. Par can also be referred as stated value. And again, this is going to work similar to the bonds. So we can actually have premiums and discounts, but we're probably going to focus on more of premiums because stock tends to sell more than what the par value is. So we're going to get into two types of stock. One is known as preferred stock. Okay, so preferred stockholders get all their money before common stock ever does. Okay, so they are paid in first. They get to cut the line. They're always going to get it. So they are limited to their stated monetary terms. So for example, a $4 par preferred stock has the right to an annual $4 per share dividend. So we're always going to get $4 because we're preferred. If the par value is 50, the same right to the dividend could be stated as 8%, or 4 divided by 50. Okay, so basically common stock people kind of get the short end. They don't get any dividends until the preferred stockholders actually get paid. Okay, so with that, what happens in the corporation doesn't pay dividends? Well, when they don't pay dividends, if there's preferred stock going on and they didn't receive their dividend, you have to start basically commutative or their preferred stock. That means you basically accrue what they're going to be owed. So it's in what they call arrears. And basically that just means all years have to be paid from dividend before common stock gets anything. And that's really just messed up. Okay? So again, preferred stock gets their dividends before common stock ever does. So common stock is what we've been mostly dealing with when we deal with basically an owner buying in. So again, we're dealing with partnerships and stuff like that. We haven't really done much with a corporation. So common stock, once they receive their dividends, they receive any additional dividends and it gets split up equally among the outstanding shares. So it don't matter how much it is, it just gets split up equally. So sometimes they could have a big payday. Sometimes you may never see a dividend ever again. Maybe out of the blue the company finally issues a dividend after never doing it. It happens. So we're going to have that. So let's get into our favorite part of this course. And that is the magical wonder of journal entries. Yay! Journal entries! Woo, 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 woo. Alright, so first thing we're going to do is issuing out our stock. And again, we're going to issue out at par value. So that means it actually got issued out for its face value. So we're going to take this example. Assume that corporation issues out a par of 5,000 shares of preferred stock at $100 par and 50,000 shares of common stock at $20 par. Well, we're going to have to do some math here. So let me show you the journal entry and let me explain it as we go. Okay? First off, I'm not worried about cash. I can get to cash later. We want to make sure we get our preferred stock and common stock. Notice they're separate accounts. These are two different stocks. They have to stay separate so we know how much we have to issue out on dividends. Okay? So, first off, preferred stock, they paid a grand total of $500K. And that's 5,000 shares times $100 par. Okay? So always take your shares times your par. Common stock is 1,000,000 because it's 50,000 shares times 20. So when we add these two together, the amount of cash we actually received from selling the stock was a good old 1,500,000. Again, it can go very quickly. Stock market is very volatile, so we can earn a lot of money very fast. Being said there, again, you're going to look at supply and demand. If a company is doing very well, people will want to buy their stock, and it may set the prices a little bit higher. Okay, when that happens, we get what is known as the premium. So, premium's back, yo. So, what's this? We assume that the corporation issued 50,000 shares of $20 par common stock for $30 share in cash. Okay, so the two easy journal entries, of course, would be the cash itself, which is just the number of shares times how much we sold them for, which was for 30 bucks. And we can easily figure that out. Again, happens to be 1,500,000. The other thing that we have is common stock. Now, common stock or preferred stock will always be sold, or the way we figure it out is shares times par. Okay, so again, we figure out how much money came in. So common stock is still 1,000,000. Well, we notice there's a difference between these two. And when there's a difference, this is known as paid-in capital in excess of par. Again, you see it's part of common stock. Okay, go 500,000. I mean, you can either take the difference or take the difference of the price, par and sell, and times it by 50,000. As you can see, here's the formula also. 50,000 shares times the $10 premium, or you can just wait till you get cash common stock and find the difference. Still the same, it will always be a credit. Okay, again, if we had a loss, we sold at a discount, we're not going to deal with that. Don't worry. Okay, so the other thing that we have to deal with is treasury stock, when we buy back our stock. Okay, so this was basically issued out with a premium. Now we get to do about buyback. So treasury stock, when it's bought back, this is stock that's going to have basically a value of how much it cost us to buy it. Okay, now since it cost us to buy it, treasury stock will have a normal balance of being debit. So it only increases by debit. This makes it a Contra Equity. Oh, Contra Equity. In fact, it basically is a negative equity. It hurts our equity to have treasury stock. But corporations will do this so that they can sell it mostly back at a higher price. That's what they're going to try to do. So let's assume a corporation purchased that 1,000 shares of treasury stock at 45 bucks. So just like this, take 1,000 times 45, and it's going to get ourselves this journal entry. Treasury stock gets debited for 45, cash gets credited for 45. Again, we bought it back just like our bonds. So we have to create treasury stock for our liability. Again, do not affect any other account when you buy back. Okay, this is already being netted out when we actually do the balance sheet. So the cool thing is we bought this back. Again, we can now sell these shares. The shares, when we sell them, usually always go first out of treasury stock, because again, we don't want to have that negative equity on our actual balance sheet. So when we sold 200 shares at $60 each. So you're going to see this journal entry. First off is the cash. 200 shares times $60 will be $12K. Notice with treasury stock, even though we sold it for 60 bucks, our cost was that $45. So we're going to take that 200 shares times by 45, because it came from this 1,000. Okay, so it's kind of like how inventory was in chapter 5. We have to keep the cost to what it is. So you also will have another paid-in capital account, because basically, again, it's all about traceability and identifying where this extra paid-in capital came from. And it's paid-in capital and sale of the treasury stock. Good old $3,000. Basically the difference between 12,000 and 9,000. Or again, if you put, well, I would actually just take the difference on this. I wouldn't try and do the 200 times 25. You can, it may come out, it may not, but it's easier just to take the difference. Alright, so there's treasury stock. There was issuing stock and issuing stock at a premium. Next, the biggest other equity, of course, is something we've already seen. But now we get to expand on it. So we're expanding on dividends. Bum, bum, bum. And you're going to have 3 very important dates. One is going to be the date of declaration. And this is when the board actually declares a dividend. When they declare a dividend, we have to recognize it. So we're going to debit basically dividends and credit dividends payable. Okay, so that basically identifies that we owe a dividend to our shareholders. Okay, next date that you're going to have to deal with is known as date of record. Okay, date of record, there is no entry involved. This is only when basically accountants and other people will go out and they're going to find who's entitled to the dividend. They're going to go through their list, they're going to find their preferred, because they get dividends first, and then their common stock, and make sure everybody's ready to go for the payment. So that means your third important date is the true date of payment. This is when we make the payment itself. And the journal entry to that is basically we debit our dividends payable because we're paying off the liability, and credit cash. So this brings just an extra basically journal entries going on with dividends. Nothing really too big of a difference. Just now we got dividends payable. Key thing is know your dates. Okay, know these 3 dates because they tend to come at you fast and furious. So the next part is a little bit of stock splits. Okay, now if you ever played the game Railroad Tycoon, where you're actually owning a business, this one happens to be railroads, it would flash up once you're doing really good. A stock split means stock has now become basically divided in its shares. Corporations will do this just to adjust the price per share of its start price. Basically, sometimes they do it just to lower it a little bit to get more people to buy in. So, with this, the stock split doesn't really change the total value of the shares. Again, it just lowers the par. The individual value of shares is still the same, except you got more to actually deal with. You can sell off more. You don't have to sell off 4 or stuff. So again, this example just shows number of shares before split was 10,000 times 100 equals a million. But if I decide to split it 5 to 1, this is basically what it is. It's just a ratio. So it jumps up to 50,000, drops down the price to 20 bucks, and still a million. Okay? So the pie does not change. Value does not change. It's just going to have more pieces to it. We really just need to know the terminology of what a stock split is, and do not be scared. That doesn't change anything, just the value of par. Okay? Everything else is still the same on total and everything. Okay? Now, investors get to use the stock, and they're going to use the stock and create something known as earnings per share and price per earnings ratio. So we're dealing with EPS and PE. I'm not talking about the PE where you actually put on gym shorts and stuff like this. No, we're actually still dealing with stocks. Okay? So, formulas that you do need to know. EPS is going to be equal to net income minus your preferred dividends. Okay? Divided by average number of common shares outstanding. Okay? Remember, it's this one, the big key thing is it's preferred dividends. We don't care about the common stock. Okay? Don't care about the common stock dividends. Don't care what they get. We deal with the preferred. Okay? So, this is more towards common shareholders. Because mostly common shareholders is what we see on the New York Stock Exchange. You don't really see preferred stock there. And this tells us basically if things are going good. This is earnings per share. How much are we going to earn for this stock? The next one is basically PE, the price per earnings ratio, or price over earnings. But we're going to take the market price of one share. So you go look on the stock exchange, find Apple at 100,000 for one share, could be possible, divided by earnings per share, or your EPS. So this will actually tell us if it's good or bad. Okay, so investors who trade on stock regularly talk about the PE. Okay, lower PE stocks, such as 10 to 15, and their ratio of what PE equals, are generally referred as value stock. Okay, they're low, they're cheaply. Okay, higher PEs between 50 and 30 are known as growth stock, and basically they're going to grow very quick. Investors are paying a high price for them and expect that the earnings will grow significantly. So if you were able to get on the buzz for basically Amazon when it first came out, man, that would have been the definition of a growth stock. Or even Facebook right now. Yes, it had a dip when it first came out, but man, it grew pretty good. Other stocks that you probably go and find that it's like GameStop has lowered completely. So when you're dealing with stocks, just check trends. Okay. So now we can actually look more into what the equity section looks like on the balance sheet. It is now expanded. So we now have contributed capital, which is our preferred stock first. Again, this is preferred 10% stock at $50 par value, 200,000 shares, and I'll show the amounts. Common stock is next, and then any additional paid-in capital. Usually, again, we like to keep that to these, have multiple ones for common stock and preferred stock if needed. Same thing if we have treasury stock, but treasury stock will be down here. And then next you usually see retained earnings. Okay, so this is again gonna have all of our contributed capital plus or minus wherever the retained earnings are, and we're going to have a total. Then you see has a separate thing is treasury stock. We always deduct treasury stock, so don't add it. That's why we even have deduct. But some documents you won't see, you just see treasury stock. Remember, it's always a subtraction. And it's always whatever it is at cost, how much we bought them for. Just so happens the total ends up being $27,000 right now. So our equity is actually $1,525,000 that's invested in this company. Okay, so always keep an eye out and make sure you kind of understand how this is going. Alright, so with corporations, you're going to find out there's one major state that all corporations tend to fall under. If you look, it's a good old state that's probably the smallest one, the smallest in the nation, and that's Delaware. Delaware has basically the most favorable laws for corporations, so everybody goes in corps in there, or basically they do their papers saying that they're incorporating in that state. Once they do that, they can build their headquarters anywhere. Okay, notice a few that actually basically do in different states. Normally they really stay all in Delaware. If you become a corporation, you go in Delaware. For some reason, just because it really brings a lot of easiness to it. Okay, Starbucks, of course, went with their home state of Washington. GE, the Thomas Edison company, did it in New York. So there's always good. So it's always nice. Good trivia question if you ever have it. What's the #1 state? Okay, so let's finish this off. And of course, we got some review activities just because we have a little bit of items to go through. And it's kind of like a refresh of also chapter 10 if you go to this chapter. So, if a price, again, of stock is greater than par value, then it is sold at a premium. If it's the other way, it's sold at a discount, but again, we're not really focused on discounts. And net income minus preferred dividends divided by that average number of common shares is going to be our cool EPS, earnings per share. Okay? So which of the following is true about a corporation? If a description is false, then why? Owners of corporations have fully liability. No, it's all limited liability. Corporation is taxed separate from its owners. That is true. Corporation has a life limited to its owners. That is false. Corporations live forever. Okay? They're going to stay on forever. They come back from the dead like Toys R Us did. Or Circuit City. Maybe Radio Shack will eventually come. KB Toys announced that they're coming back. Stores come back all the time. Corporations never die. They just go dormant for a little while. They burst back onto the scene. Okay? Number 2. Under formation on May 12, 2015, Big Zero issued 300 shares each of $10 par preferred stock and $8 par common stock. let's prepare the journal entry. Okay, so it's 3,000 shares each. So we're going to have okay. So with that being each, you're going to have preferred stock of 3,000 times 10. That'd be 30,000. Common stock is 24,000. 3,000 times 8. And then add those two together, and you get our cash, 54,000. Okay, so cash is always debit, preferred common is credit. This is the start or issued out of stocks. Okay, so little quiz. Let's do a quiz. Woo! No, I'm kidding. Basically, again, this is our practice problems. So we're gonna have a lot of stuff going on here. We're gonna get through these like dividends and stuff, and that's gonna be basically it of this video. So problem number 1. Precise Corporation has stock outstanding as follows: 100 shares of 10% cumulative non-participating preferred stock of 100 par, okay, and 100,000 shares of $5 par value of common stock. During the first 2 years of operation, the following amounts were distributed as dividends. First year was 500,000. Second year, 1,500,000. Okay, and third year was $3 million. And it's going to ask you what amount would be paid to common and preferred stock, both in total and per share, for each of the first 3 years. Okay, so when we're looking at this, we gotta know how much value is basically in our preferred stock. Well, we'll take 100 of the par times 100,000 shares. That means $1 million. So preferred, of course, gets paid first. We only issued out dividends of 500,000. So that means preferred got the whole 500K, common stock got nothing. Okay? So $5 per share. Not too bad. Again, once we actually figure out how much, again, we divide by 100,000 and it makes $5 per share. Now, in year 2, we issue out 1,500,000. Now, watch what happens. Common stock still gets 0. Why? Well, the reason behind this was, of course, par or preferred did not get its full amount. Okay, it was supposed to get 1 million. It only got 500K. So the additional 500K goes forward, goes into next year. So they still have to pay the 500K plus now another million. So happens that they made enough money to do 1,500,000. So they were able to pay preferred stock back completely. And they get $15 per share. Next one, year 3. Well, common stock finally gets money. Okay? First off, we've already paid back preferred stock completely. Now we're up to 3 million. Preferred stock gets its all 1 million right up front, or basically $10 per share. Common stock gets the 2 million. This time they get $20 per share. So it takes a little while for common, but once it does, sometimes it can be very, very large. It can be very, very small. Just depends as long as it's over preferred. Okay? Our problem 2 is dealing with Limerick Corporation. If you haven't heard about Limerick, look up Limericks. It's always the men from Nantucket. But they issued for cash of 25,000 shares of $10 par common stock at $20. On May 19th, Limerick issued for cash 20,000 shares of 4%, $5 par preferred stock at 40 bucks. Journalize the entries that recorded on March 6th and March 19th. Okay? So the first one that we got, we're going to have a premium. I'm going to tell you that right away. So, with this, cash itself is 25,000 times 20. We sold them for 20 bucks. Okay? So, that means we received cash of 500K. Awesome sauce. Our common stock, though, only had a par value of $10. So, 10 times 25,000 is 250K. That's how much that actual, basically, face value of the common stock we sold. So, because it's not equal to 500K, we're going to have a little bit of paid in excess. So they paid a little premium of additional 250K. Okay, so that's the issue right there. Now preferred, we also have a little bit of an excess. This one we have a lot. Okay, first off, they paid 40 bucks for the 20,000 shares. We're not even looking at the 4%. We're looking at $40 per one that they paid. So that's 800K. Our preferred stock, we only gave it a $5 par value. So again, 20,000 times 5 only gives us 100K. So we have paid in excess of 700,000. That's a lot. Okay, that they paid extra. You must have been really good. Again, always watch out on your dates too. Okay, March 6th, May 19th. But that's a lot. Well, let's go into problem 3. Okay, problem 3 is dealing with dividends. Okay, yay, dividends! Woo, woo, woo. So, the important dates in connection with cash dividends of $250,000 on the corporation common stock are February 26th, March 30th, and April 2nd. So, in our series of events, the first thing we have to do is the date of, declaration, which of course says we are going to issue out these dividends. The board of directors came. So, we're going to take dividends and we're going to debit it. No, it says cash dividends, but you can actually do dividends. And then we're going to credit dividends payable. We owe those dividends out. So we're always stating that we owe dividends to our shareholders, be it however they get it. So, next one is going to be April 2nd. So, April 2nd comes along, and it's basically the reverse going on. Dividends payable gets debited, but now we've actually issued out the cash. Okay, notice again, there is no date or no journal entry for March 30th because that is the date of record. Okay, that's when we figure things out. All we have is basically the first date, which is date of declaration, and then the date of payment on April 2nd. Okay, and that's it for chapter 11. That's going through everything. Okay, so if you have questions, again, leave those comments below. I will make sure to answer those as quickly as possible. If you have anything else, any suggestions, you're more than welcome to also comment. But anyways, this has been another episode in the glorious Accounting 2301 with your host, Professor Naragon, signing off.